Welcome back to the Crypto Intellect, the channel where we break down the biggest developments in crypto, digital assets, and the future of global finance. Today's headline is turning heads across the entire market: XRP news. Today, banks just picked XRP. It's over. For years, critics mocked XRP and called it the banker's coin, as if it were some kind of weakness. They used that label to dismiss Ripple's strategy and argue that true innovation could only come from projects that rejected traditional finance. But now something remarkable is happening. The very institutions that many believed XRP was built for are moving deeper into tokenization, digital settlement, and blockchain-based financial infrastructure. Suddenly, that old criticism is beginning to sound less like an insult and more like a prediction. Before we get into the details, let me know your thoughts in the comments. Do you think banks choosing XRP-related infrastructure changes everything? Or do you think the market is still underestimating what is happening behind the scenes? As always, this is not financial advice. This content is for educational and informational purposes only, so always do your own research before making investment decisions. What makes this story so important is that it forces investors to ask a question that almost nobody in crypto wants to discuss honestly. If speed alone determines success, why aren't the fastest chains automatically dominating institutional adoption? If transaction throughput was the only thing that mattered, why aren't major banks and settlement networks rushing toward every new blockchain that appears? The answer is much more complicated than most people realize. Institutions do not make decisions based solely on technical specifications. They are responsible for moving billions, sometimes trillions of dollars across global financial networks. Their priorities are different. Reliability matters. Compliance matters. Regulatory clarity matters. Existing relationships matter. Integration matters. In other words, institutions do not simply ask which blockchain is fastest. They ask which blockchain can safely and legally connect to the financial system they already operate. That distinction changes everything because it shifts the conversation away from theoretical technology and toward practical implementation. And that is exactly where XRP has been positioning itself for years. A recent discussion involving Ripple executive Ashish Birla highlighted something that many retail investors overlook. According to his explanation, winning at the institutional level depends on three major pillars. The first pillar is technology. That is the part everyone talks about. Technology includes settlement speed, scalability, security, efficiency, and the ability to move tokenized value. XRP was specifically designed with these goals in mind. From its earliest days, the XRP Ledger focused on transferring value quickly and efficiently while maintaining low transaction costs. But here is the surprising part. Technology alone is not enough. Birla suggested that technology represents only a fraction of what institutions actually require before they commit to using a platform. That idea challenges much of the conventional thinking within crypto. Many investors spend years debating transaction speeds and technical upgrades while ignoring the larger framework required for real-world adoption. According to this perspective, technology is necessary, but it is only one piece of a much bigger puzzle. The second pillar is what Birla described as connective tissue. That phrase is incredibly important because it captures something that cannot be created overnight. Connective tissue refers to the relationships, partnerships, integrations, licensing frameworks, and operational connections that link blockchain technology to the existing financial system. Think about the payment processors, banks, clearinghouses, and financial institutions that already move money around the world every day. These organizations operate within strict regulatory environments and complex infrastructures. Connecting a blockchain to that ecosystem takes years of work. It requires trust. It requires approvals. It requires legal compliance. Most importantly, it requires patience. This is where Ripple has spent a significant portion of its effort. While many crypto projects focused almost entirely on technology, Ripple focused on building relationships with institutions. Those relationships became the bridge between blockchain innovation and traditional finance. Whether investors agreed with that strategy or not, the groundwork was being laid year after year, while much of the crypto community was looking elsewhere. The third pillar is regulation, and this may be the most controversial topic in all of crypto. Regulation is often viewed as an obstacle, but institutions see it differently. For banks, asset managers, and major financial firms, regulatory certainty is not optional. It is essential. Without it, large-scale adoption becomes almost impossible. Ripple spent years pursuing licenses, engaging with regulators, and participating in discussions surrounding digital asset policy. That effort was not always popular within the broader crypto community. In fact, some critics viewed it as a compromise of crypto's original ideals. However, when institutions evaluate blockchain infrastructure, regulatory readiness becomes a major advantage. The ability to operate across multiple jurisdictions, comply with evolving rules, and work directly with policymakers can create a significant competitive edge. This is one reason why many observers believe Ripple's long-term strategy was always aimed at institutional integration rather than retail speculation. Whether people agreed with that approach or not, it appears increasingly relevant as tokenization moves toward the mainstream. When you combine these three pillars, technology, connective tissue, and regulation, a very different picture of the XRP story begins to emerge. Instead of viewing XRP solely as a cryptocurrency, it starts to look more like financial infrastructure. That distinction is critical. Infrastructure is not always exciting. It does not always generate headlines. It often develops slowly and quietly. Yet infrastructure tends to become extremely valuable when adoption finally arrives. Think about roads, railways, internet cables, or payment networks. Their importance becomes obvious only after they are integrated into everyday activity. Ripple's supporters have argued for years that XRP was being built as infrastructure for the future movement of value. Critics dismiss that argument repeatedly, but now, as tokenized assets become a serious focus among major institutions, those infrastructure discussions are receiving much more attention. The debate is no longer just about what XRP could become. It is increasingly about what has already been built and whether the financial world is finally ready to use it. One of the most overlooked aspects of the XRP ledger is its native approach to tokenization. Across much of the blockchain industry, tokenizing assets often requires custom smart contracts. These contracts introduce flexibility, but they also introduce complexity. Every new contract creates another potential point of failure. History has shown that vulnerabilities in smart contracts can lead to significant losses. Institutions are aware of these risks. They do not want unnecessary uncertainty when dealing with valuable assets. The XRP Ledger takes a different approach. Asset issuance is built directly into the protocol. This means many tokenization functions can be handled natively without requiring the same level of custom coding found elsewhere. Supporters argue that this creates a more predictable and secure environment. For institutions exploring tokenized bonds, equities, currencies, and other real-world assets, predictability matters, consistency matters, risk management matters. These are not minor considerations. They are central requirements when dealing with large-scale financial operations. Security becomes even more important when billions of dollars are involved. Institutional investors cannot afford to experiment with infrastructure that lacks a proven track record. One reason XRP continues to attract attention is the long operational history of the XRP Ledger. Since its launch, the network has processed enormous transaction volumes while maintaining reliability. For institutions evaluating blockchain options, years of performance data can be more valuable than ambitious promises. They want evidence. They want history. They want systems that have already demonstrated resilience under real-world conditions. This is where established infrastructure often gains an advantage over newer competitors. Innovation is valuable, but institutions typically prioritize stability when large sums of capital are involved. The combination of operational history, predictable settlement, and low transaction costs creates a compelling case for organizations seeking dependable blockchain solutions. Whether that ultimately leads to mass adoption remains to be seen, but the foundations are undeniably attracting attention. Another feature that deserves discussion is the XRP Ledger's built-in decentralized exchange functionality. Unlike many blockchain ecosystems that added decentralized exchanges later, the XRP Ledger included exchange capabilities at the protocol level from the beginning. This creates interesting possibilities for liquidity and asset movement. Every tokenized asset issued on the ledger can potentially interact with the native trading infrastructure. Supporters argue that this architecture becomes especially valuable in a tokenized economy, where countless assets may need efficient pathways for exchange. Liquidity is one of the most important components of any financial system. Without liquidity, markets become inefficient and expensive. The ability to facilitate movement between different assets quickly and effectively is a major consideration for institutions exploring blockchain-based settlement. As tokenization expands, these underlying mechanisms may become increasingly important. The discussion is no longer limited to cryptocurrencies themselves. It now includes the broader infrastructure required to support a digital financial ecosystem. Settlement efficiency is another area where XRP supporters believe the network has a strong position. Traditional financial systems often involve multiple intermediaries, delayed settlement windows, and operational inefficiencies. Blockchain technology offers the potential to streamline many of these processes. The XRP Ledger is known for fast settlement times and extremely low transaction fees. Those characteristics are not merely conveniences. For institutions processing large transaction volumes, they can translate into meaningful operational benefits. Faster settlement reduces counterparty risk. Lower fees improve efficiency. Predictable transaction costs make budgeting easier. When viewed through an institutional lens, these factors become practical business considerations rather than technical talking points. The ability to move value quickly and cost-effectively is one reason blockchain technology continues to attract attention from major financial organizations around the world. Compliance tools represent another major piece of the institutional puzzle. Traditional finance operates within a framework of identity verification, anti-money laundering requirements, sanctions screening, reporting obligations, and regulatory oversight. Any blockchain hoping to support institutional adoption must address these realities. The XRP ecosystem has increasingly focused on integrating compliance-oriented capabilities. Supporters argue that these features make the network more attractive to regulated entities seeking blockchain solutions. Critics may view compliance mechanisms as contrary to crypto's original ethos, but institutions generally see them as necessary components of participation. The reality is that regulated financial organizations cannot simply ignore compliance requirements. They need infrastructure capable of supporting those obligations. As tokenization continues to evolve, the intersection of blockchain innovation and regulatory compliance may become one of the defining themes of the next phase of digital asset adoption. One of the biggest challenges facing modern finance is liquidity fragmentation. Capital exists across countless markets, jurisdictions, institutions, and platforms. Moving value efficiently between these environments remains difficult. Ripple's broader vision has often centered around addressing this fragmentation. Through various products and partnerships, the company has sought to create pathways that connect traditional finance with blockchain-based systems. The goal is not merely to build another cryptocurrency network. The goal is to create infrastructure capable of facilitating seamless value transfer across diverse financial ecosystems. If successful, such an approach could unlock significant efficiencies. That vision helps explain why institutional connectivity has remained such a central focus of Ripple's strategy. Rather than attempting to replace the financial system entirely, the company has concentrated on integrating with it. Whether that proves to be the winning approach remains a topic of debate, but the strategy has certainly differentiated Ripple from many other projects in the space. Recent developments involving tokenization initiatives have added new fuel to the conversation. Organizations throughout the financial sector are exploring how blockchain technology can modernize settlement infrastructure, improve transparency, and reduce inefficiencies. Tokenized assets are increasingly being discussed as a major growth area. This trend matters because XRP was designed with value transfer and financial infrastructure in mind from the very beginning. As more institutions investigate tokenization, networks capable of supporting those activities may attract increased attention. The significance is not necessarily that every institution will choose XRP. Rather, it is that the market environment is moving closer to the use cases XRP was built to address. Sometimes the most important developments are not immediate announcements but gradual shifts in industry priorities. When the industry begins moving toward the problems your technology was designed to solve, opportunities can emerge quickly. The narrative surrounding XRP has undergone a remarkable transformation over the years. There was a time when institutional alignment was often portrayed as a disadvantage. Many investors preferred projects that positioned themselves in direct opposition to traditional finance. XRP took a different path. It focused on working with institutions rather than fighting them. For years, supporters argued that this strategy would eventually prove valuable. Critics argued the opposite. Today, the debate looks very different because institutional adoption has become one of the most important themes in the digital asset sector. Whether discussing tokenization, settlement, custody, or blockchain infrastructure, major financial organizations are playing an increasingly active role. As a result, the qualities that once attracted criticism are now being reevaluated through a new lens. What makes this moment particularly fascinating is that the underlying infrastructure did not appear overnight. The licenses, relationships, integrations, and technical capabilities being discussed today were built over many years. They were developed during periods when market attention was focused elsewhere. Infrastructure often works that way. It is constructed quietly, long before the public fully appreciates its significance. By the time everyone recognizes its value, much of the difficult work has already been completed. That reality helps explain why many long-term XRP holders remain focused on institutional developments rather than short-term market fluctuations. They view the story as one of infrastructure maturation rather than speculative excitement. Whether that perspective ultimately proves correct will depend on how adoption unfolds in the years ahead. As we wrap up today's discussion, the key takeaway is not that XRP has already won. It is that the factors supporting the institutional thesis are becoming increasingly visible. Technology, regulatory engagement, and real-world financial connectivity are all areas where Ripple has invested substantial effort. At the same time, the broader financial industry is moving toward tokenization, digital settlement, and blockchain-based infrastructure. Those trends are creating an environment where XRP's original value proposition is receiving renewed attention. The phrase "banks just picked XRP" captures the excitement many investors feel, but the deeper story is about infrastructure meeting opportunity. If institutions truly embrace tokenized finance at scale, the networks that spent years preparing for that future could be positioned to benefit significantly. So now, I want to hear from you. Which pillar do you think matters most right now? The technology, the regulatory positioning, or the institutional connections? Drop your answer in the comments below. If you enjoyed this breakdown, make sure to like the video, subscribe to the Crypto Intellect, and share it with someone who needs to understand what is happening beyond the headlines. Stay informed, stay prepared, and I'll see you in the next one.